All right, everybody's hopefully back. Can everybody see my screen still?
Yep.
Thank you. All right, share record. Okay. Anyway, commitment to you guys here is talk about the stories about Des Moines. Here, this is all about Des Moines multifamily. Now, how I describe Des Moines, Central Iowa. Here, this is a 35-mile radius around Des Moines. So this encompasses Ames, Newton, Adel, Indianola, all the other things. So I want to make sure we all know what we're talking about here when we talk about what we're going to talk about for stats and stuff. We're going to look at the quarterly data breaking down the first quarter of 2025, or what's happened from January to April 1st here. And we're going to hear some stories about the marketplace, some stuff that's sold, stuff that hasn't been selling, etc. And we're going to kind of go through what we're hearing about in the marketplace. And then we're also going to hopefully get some information from that so we can all hopefully go out and make more money together in this thing called real estate, specifically multifamily real estate here. And as many of you know, I love climbing mountains. And so I always like having this quote right off the bat from Maya Angelou. You can't really know where you're going until you know where you've been. And that's going to be kind of, again, the story we're going to be talking about here is looking at in the past to kind of figure out where we're going as well, which is, again, you're going to hear some more of that theme here as we go forward and go on here. So I like to just get this out of the way right off the bat. Spoiler alert. Prices are up. If you haven't noticed, year over year and quarter over quarter, we're seeing pricing up almost 30% right now in the marketplace. Now we're going to dive into that here because there's always nuances in the data. You know, there's always that saying that's the statistician who drowned in 3 feet of water. Because again, you can have nuances as we get into this data point as well here. So we're going to look into everything here and kind of dive into what we're seeing. But simple answers is Des Moines multifamily is strong right now for pricing. And we're going to talk about what we're seeing there for prices. So if you don't know me as well, this is again for anybody that's kind of new to this or has not heard of me before or seen this. Why would you trust me to say some of the things we're talking about here? Some is going to be new for some of you, some will be old for everybody else here. Just my experience as an agent, over 10 years now being a real estate agent, conduct over $100 million of transactions for clients and personally as well. The average IRR for my buyers right now is hitting 26.95%. So we're seeing really strong buyers. My sellers right now are averaging about 95% offer to ask ratio, all done by myself. No team members, it's just me and my virtual assistant here. This isn't me pulling from stats from some big company like CBRE or JLL saying we've done a billion. No, this is all just me, myself, and I. Why I became an agent, for some of you don't know, I've been an owner for about 15 years now, almost 17 years now, I think. And so I actually became an agent because I hated agents. I didn't think agents ever really did much for me. They just called me when they wanted me to buy or sell something. They never really helped me. They never gave me stats. They never did quarter reports. They never did webinars. They just called me and said, I want you to buy something or sell something. And they never really did anything. And a lot of times they were hiding behind performas too, which we've all seen performas. Anybody's seen the bad ones? I'm sure we've all seen the performas, and performa just is Latin for the broker made it up. And they just never really seemed to actually care about what was going on really in the marketplace. And many of you know, I think I've been called like the most honest broker in town before, most honest agent in town, sometimes to my detriment. But I like to tell the truth, and that's why I'm here. Um, that's what I think good agents should do. I think good agents should tell you the truth, tell the real story of the property here, give you the whole thing, help you make more money, maybe expand your thinking too. I mean, sometimes there is a time and place for performance. There's a time and place to look out as well. So I think that's part of an agent's job too. And we're going to talk about that a bit later on about what we're seeing in the market for expansion. If there's anything I missed that an agent should do, feel free to throw it in the chat. I'm always looking for feedback from you guys. If there's anything you ever want to see from me and my team, let me know. We'll try to figure it out or build it. Whether it's our Catalyst kickoff videos, that was done by you guys wanting to see our every weekly sales and stuff. So that was all just you guys. So if you missed anything, throw it in the chat. And again, we want to be here as agent partners for you guys. And if you've seen me before, I know Tina, I talked about this. I love my movie quotes. So you're going to see movies, pictures of them, videos of them, quotes throughout here as well. There's a spot in The Matrix, I think the second one, where the agent Smith says he wants more. You know, he wants to see more agents come in to fight Neo. And so if you want more reasons why, I'm going to show you an experience here. So this is an experience as an owner. This is actually the Eddy Apartments. Some of you may or may not know this one. It's over there on Polk Boulevard, 64 units. And ironically, this is actually a deal that I never actually bought. And so you're probably asking yourself, like, why would I show you guys a deal I didn't actually buy? Like, that's kind of a weird way to show experience as an owner. And so what I mean by this though is there's a lesson I learned on this deal. It's just sometimes the best deal you do is the one you don't do. It's something a mentor taught me back in the day was we always want to talk about the deals we missed out on, but sometimes doing deals is actually a blessing in disguise. And this is going to be a kind of a theme of the presentation we're going to get to later on, especially as we're talking about what's currently happening in the marketplace and some listings. So we're going to go into that a little bit more here, but that's with Eddy Apartments. It was a deal I never did. Now, with that being said, I still wish I had done that deal. And here's why I still wish it. Back then, I could have bought it for a true 10 cap. It was a 10% cap rate in 2013. I was buying it for less than $20,000 per unit. And for any of us who know the market today, we know that would be a very, very, very good steal. Because back then that was way, way below what today's prices are. I mean, right now we're about 100,000 a door, 80,000 a door as well. So I'm assuming there's people on here, plenty of us, who have regretted not doing a deal. There's always those deals you look back and say, man, I wish I would have bought more or done more. Or I should have bought that or could have bought that as well. So, but there's still lessons here. You know, we can't look back, we can only go forward. And that's, again, kind of the theme of the presentation. And one thing that I realized as a lesson, the reason I regret not doing that deal isn't the deal, it's the market cycle we were in. I didn't realize what market cycle we were in back then. I was wanting to buy the deal, and what actually happened, there's actually a lot to that deal. There was a lot of headaches, a lot of problems. In fact, that current owner and I are still friends, and I talked about some of the problems he's had at that deal. There was a fire, there's been a lot of vacancy issues, etc. So I don't regret not doing the deal because it would have been a huge headache and a lesson for me I never would have figured out maybe. But I regret it because, again, the market cycle we were in back then was different. And so I'm going to spend a few minutes here talking about market cycles. Many of us know what these are, but I think it's important for us to recap here that we really have 4 cycles for a market. We have, you know, occupancy's down, we're coming in the opening stage here, market's going up. We go to expansion, demand equilibrium, we have hyper supply, and of course we have a recession. You know, we go up, up, down, and around, okay? So out of curiosity, if anyone wants to throw it in the chat, what market cycle do you think we're in today? Like, where do you think we're at? Feel free to ask yourself the question, maybe put it in the chat box. You know, maybe we're in expansion, are we in hyper supply? Are we in growth, which is phase 1, or are we in recession phase 4? If you're following the stock market today, you might be feeling a little bit depressed, at least in the last week or two. And so here's my prediction, and we're going to talk about what my prediction is and why. Is if you look at this report that we're going to have, we're going to dive into this quarter report, I would say right now we're right about here. We're somewhere near the top of the market. Now, I think this report, what's missing is I think today, April, whatever it is, 14th, we're actually lower. And so what I mean by that is all these sales happened in the past. All these sales are reflections of a market that was 30, 60, 90, 180 days ago. Commercial real estate takes a long time to close. So all these deals that we're looking at, they closed in January. They were getting financed back in November or October, maybe even going on the market back August. Deals that are closing in April, same thing. They were getting listed back first of the year here. And so all of these deals are happening in the past, which is why I think that today's market is actually different than what this report's going to show here. Now, with that being said, I'm not saying I know what the future is going to bring. I don't know what the future is going to be or hold. And anybody who says they know what the future is going to do, they're doing one of two things. They're either trying to sell you something or they're lying to you. These are always my sayings here as well. If someone says, I know the market's going to go up or down, Bitcoin's going to be great, Trump's going to make everything awesome, they're lying. They're lying or trying to sell you something. Some things I'll buy and believe, some things I won't. For example, things I'll buy. If you tell me it's going to be cold in Iowa in January, I'll buy that. That's probably a pretty good idea. If you tell me the Iowa Hawkeyes are going to punt the ball, I fully believe that because for Iowa, punting is winning. Okay, so I believe that's going to happen. The market will go down someday. Is it going to be today? Is it tomorrow? Is it already in that? I don't know the answer to that. But the reason I buy all these things is because of history. And so what we all look back to is say, okay, if I think this report is showing historically we're at here and today we're here, we could in theory tomorrow be down, we could be neutral, or we could be up. I don't know the answer. We're just going to try to use this past report, these past cycles to look at this here and make our best predictions. And I actually going to talk a little bit about, I think certain asset classes are going up, certain are staying right there neutral, and some are actually going down here. We're actually going to get to that in a little bit later on here. But we're going to look back in the past to predict the future. We use historical data to predict. That's why we know it's going to be cold in Iowa. We know Hawkeyes are going to punt, because we're looking at all of this past history here. We use that to make predictions going forward. This is the historical data I track, right? This is actually an exact screenshot of the Excel sheet that I utilize for all this information here. This is the sale of every property in central Iowa here over the last 8-9 years. And each piece of data I track every quarter. It takes about 2 to 4 hours. It's actually closer to like 8 years now. It's a little bit outdated there. And it's about 120 pieces of data from the entire marketplace, each sale over the last about 8 years. If you guys ever want access to this, just give me a call. I won't give you the names of all the buyers because I probably can't. But I have over 8 years of data, 120 pieces of information on each sale over the last 8 years. You break it down, it's like 52,680 pieces of data. Just on Des Moines, Central Iowa multifamily. This is all the historical data that I'm looking at to try to predict where we're going. And this is what we're doing this Organic Report for. So you guys can do the same thing. You can have the same Excel sheet. It just takes time and research here and a lot of calls. Or you can just call me, access the data, and we'll talk about it, set some goals, and we'll make some money. Any questions? This is relaying back to the Bumblebee and Transformers there. Any questions as we break down anything so far? I'm assuming not, but feel free to jump out. So where are we right now? Let's see the market. We talked about market cycles. We talked about the historical data that I have here. So let's see where we're going to go here. Now, for any of you who've been on this before, this is going to be a bit repetitive here, but these are the metrics we're going to look at and track the most when it comes to sales and values. Sale prices, sale volume, price per unit, price per square foot, and cap rate. The 5 things we're going to talk about the most. Why do we look at these numbers? Sale prices, kind of a no-brainer. We know that is. Sales volume is how much got sold. Sales volume is essentially the heartbeat of the market. How much money's coming in, going out, going in, going out. That's the sales volume. That's why we want to track it, because it really shows the health of the marketplace, if we're beating really fast or slow. Price per unit, just sale price by the number of units, pretty easy. This is a great way for us to track comparable sales. So to say, hey, price per unit, it's 85,000 unit, 120,000 unit, et cetera here. It's a great way to use one of our 3 metrics for underwriting a property, which all appraisers and banks want to do. One of the ones is comparable sales, which is what price per unit works great with. Price per square foot, sale price by square footage. This is a really great metric for us to track the rebuild approach, which is your second thing we're going to talk about here in an evaluation here. Rebuild approach is what would it cost to completely rebuild and redo this structure in today's dollars. We're seeing that go up quite a bit right now with inflation. From out there who's actually building right now or doing construction, this number is jumping up quite high. And so using that to compare what things are selling for is a great metric for us to look forward of what we could replace the property for. Of course, the one we all like the most is cap rate, which is the sale price divided by net operating income. And of course, this tracks the income from a property. Now, as many of you have heard me say before, we have to always remember that the income from a property is just like apple juice to an apple. An apple can make apple juice here, but again, it's just a derivative. It's something that comes from the property itself. If you've been following my Owner's Advantage emails the last few weeks, I've been talking about how if a property is poorly constructed, you're going to get bad income from a property here. This is why there's a lot of intrinsic value on certain properties that people don't always recognize, because it's going to make better, quote unquote, apple juice. A bad apple juice. Good apple, better apple juice. It's kind of simple, but that's something we want to always look at. And so these stats together with the sale prices, the sales volume showing the health, comparable valuation, rebuild valuation, and the income valuation, they help us track the health of the market, where sale prices are at, and they give us all 3 metrics to look at where values are currently at. Again, no questions I'm seeing, so I'm just going to keep pushing on here, keep talking about things here as well. As I talk about movies here, nothing's ever for sure, though. This is the only thing that we know. And this comes back from The Beautiful Mind with Russell Crowe. So getting into the stats here, what do the last 6 months tell us about the future? Well, so far in Q4 and Q1, I did do a track on this here. We've had 32 properties get listed in just central Iowa here that were officially listed. This is not pocket deals. This is not deals that were done. This is officially hitting the market through CBRE, through LoopNet, through Crexi, through Marcus and Millichap, through JLL, through all the different mortgages, the Catalyst team here as well, and that's what's been listed. We've only seen 16 transactions take place so far this year. So far what we're seeing is a 2-to-1 metric. 2 deals get listed, 1 deal gets sold. Now that's a bit misleading because of those 16 sales, I know at least 4 of them were a portfolio sold that was not actively marketed across most of the market. And so that's a bit misleading because it actually has 16 sales, but it was actually about 12 transactions. And again, one of those was done with 4 properties quietly throughout the market as well. So it's a bit misleading here. What I have been seeing recently here, if you're going to follow my Catalyst kickoff, we're seeing about 4 new listings hit across all of Iowa and about 1 sale per week right now. So we're definitely seeing more and more sellers come out to the marketplace and buyers not buy, which is again why I think this report's a little bit outdated, and we're talking about that as we go on. Now, going in the actual stats here, sales volume for Q1, 69.7 million in change. There was at least 1 unconfirmed sale. We saw price per unit skyrocket to 124,269. We saw price per square foot go up to 128.98, and we saw cap rates about 5.91%. And so what we can say is, as you always love Russell Crowe here, you can see a theme here coming in a bunch. Are you not entertained? So we're looking at all these things here, but just like how I love my movies, none of these stats matter alone. You have to look at stats over different quarters and years to get more of the story here. A single thing is just a frame. And so we have to really start looking at quarter over quarter, what are we doing here? So let's look at what's happened from Q4 to Q1. Well, sales volume from the 4th quarter went from 53.2 million to 69.7 million. We saw a pretty huge increase in sales volume, again, coming into first of the year. What happened with price per unit? Drastic increase. 75,420 was the average price per unit in Q4 to 124,000. That's almost a 50% increase. Actually, more than that. Actually, probably like a 120% increase. Huge amount there. We saw price per square foot go up from $89 to $130 almost. Again, huge prices go up in price per square foot. And we saw cap rates actually go up a little bit, which is a little bit misleading here. We see cap rates go from 5.44 on average to 5.91. Now, that's a little bit misleading because that 5.91 was, I know, at least 1 pro forma cap rate from a broker. That 5.44 in the Q4, that was actual cap rate. 100% I know because I've seen every deal that sold in the 4th quarter. So if we want to compare these across markets, one that I noticed right off the bat is that the average property selling in the 4th quarter was 75 units built in 1963. That's the first thing I noticed. Second, I noticed is that the average property sold this year, 2025 quarter, was 37 units built in 1982. And so this newer age property, this newer vintage, does help explain why we were seeing such a high price per square foot and the high cap rates, or sorry, low cap rates and also high price per unit go up. Because again, we're seeing a newer property, by almost 20 years newer property. So an example of this here is 6201 EP True Parkway. This is the Polo Club. If you haven't heard, it did sell last quarter. True cap rate confirmed 5.25, 277 units built in 1980s. And this one sale comprises 54% of the sales volume of Q1. So this one sale by itself is almost the entire market. And if we remove this one sale, we still see prices though very high, 31.7 million, much lower sales volume. You see that sales volume drop quite a bit, but our price per unit is still up, 111,672, price per square foot, $131, and cap rate still 5.38%. So even if we remove this sale, we still see a really healthy marketplace. A little bit lower on the sales volume, but the price per unit, price per square foot, cap rate are all still in line. And so the takeaway so far, looking at quarter over quarter, it looks like we're still seeing prices up substantially right now. Coming into this 1st quarter here, we're just seeing those things come up. And year over year, we're going to get to here in a second. So just kind of as a summary here for one quick thing, if you want to see it all just in one visual aspect here, this was your sales volume increase quarter over quarter, price per unit increase quarter over quarter, price per square foot, and your cap rate. This is all right there. Visually out, so you can kind of visually see where everything's going, and basically it's all just going up right now. So any questions about Q4 or Q1 2024 2025 multifamily apartments? Any questions so far about anything I've shared? Not seeing any. So now we're going to talk a little bit about, it's plausible enough, but wait until tomorrow. Again, the time machine. It's also a book and a movie. That's kind of a bad picture there. But again, let's look at what the last year was. Let's see what Q1 of 2024 was like. Well, if we look at Q1 of 2024, 63 million to 69.7 million. So pretty similar actually sales volume year over year. It looks like it's higher in the chart here, but again, fairly similar, only about $6 million difference, about 10% difference in our sales volume year over year. If we look at price per unit though, we're going to see a huge price increase. We're going to see price per unit go from 58,581 to 124,269. So this is year over year. We've seen a huge price increase. If we look at price per square foot, again, same thing, almost doubling. $17 to $19 was the average price per square foot Q1 2024 to almost $130 today. So again, almost a doubling of that. Part of that could be inflation, but we also are seeing it also in the sales. And again, cap rate, we're down 7.54 to a 5.91%. Now, again, I want to point this out. That 7.54% cap rate last year was based on some pro formas. It wasn't complete actuals. It was probably closer to like a 6.5 to a 6.75 interest rate back then as well, or cap rate, excuse me, first quarter of last year. But still, we're seeing cap rates drop significantly here. And as of at least today, the Treasury, the 10-year Treasury, which we based a lot of our cap rate metrics on, is the exact same. Year over year, our interest rates gone from 4.5 to 4.49%. So we've seen interest rates remain almost exactly the same, yet our pricing is up significantly. So let's look back to find what we can. Well, the sales volume year over year, 63 million, 69 million. Again, about 10% difference, not too much. Huge price per unit increase, huge price per square foot increase, and then a cap rate that's lower, even though interest rates are the exact same year over year. Now, what I want to look at here is, again, what's the vintage? What is selling? This is where numbers get really interesting, in my opinion. In 2024, the first quarter, the average property sold last year in the same time frame was 90 units built in 1986. Today, 37 units built in 1982. So actually a smaller product, but almost the exact same vintage has been sold. And yet we're seeing that high price per square foot, high price per unit, and the cap rate all drop, even though we're seeing that similar age. So the vintage helped explain some of the jump. Looking from the fourth quarter to this quarter, the average property helped explain some of that here. But if we look out over the last year, we still see pricing up significantly, even though it's the same age of property, which tells me, again, the market's still seeing huge value in Des Moines. So sales volume was up, as I just said. Here's the numbers, what they look like if we look at year over year. 21% increase in cap rates, 112% increase in price per unit, and 78.6% in a price per square foot year over year with the exact same vintage property of just 1980 to 1980. Interest rates are the exact same as I just said, and the average property is exactly equal. So again, we're seeing still really strong pricing come out of Des Moines. If we had one unconfirmed sale as well into the first quarter of last year, which we had one unconfirmed sale up in Ames, actually it was a student housing project as well, the property prices again are identical and prices are up 70%. So again, just continuous theme that year over year, we've seen a very similar property selling, trading hands. So what's driving this huge price increase? Well, this is a great example. We're going to come back to this here. It's the Polo Club. 38 million sale price, 277 units, 137,184 price per unit. A newer 1998 vintage. It was sold March 24th and it was 5.25% cap rate. What's interesting about this property specifically is it was actually only had one ownership group. The developer built it and owned it. This was the first time they actually sold it here. And I know because one of the partners in this deal is actually one of my partners as well in some other deals. And here's exactly what he told me. We never thought we'd sell, but we got an offer we couldn't refuse. And again, it was the first sale in decades. This is literally from developer to now a new owner. And what's interesting about this as well, this deal specifically, if you know who the buyer was, they were actually a local investment group. It's been around for a long time. So we're not just seeing out-of-state money and institutional money come and buy deals. We're seeing even local groups make bigger bets and still bet on the Des Moines marketplace. So the question we're starting to ask myself, or I'm asking myself, is the dog wagging the tail? or is the tail wagging the dog? And what I mean by that here is that we're really seeing a lot of these large sales, like Polo Club, $38 million again, coming out. That's really driving the market forward in a huge way. And so these big deals, these newer vintage properties, these bigger properties, they're really taking a lot of the sales volume and they're driving up a lot of the price per square foot and price per unit to keep those cap rates very, very low. So if we look at over the last 3 or 4 years, this is the average vintage of property sold almost every quarter. Now, what I want to point out is we see a spike. You see the spike happens right there, first quarter of last year and first quarter of this year. These two, again, help explain it, but you're seeing a lot of these older projects here trade hands, but the newer stuff is pulling everything up right now. And who's buying these newer projects? We're seeing this again a lot, out-of-state money. 65% of the buying market right now for Central Iowa, Des Moines, is out-of-state money coming from California, New York, or Colorado. And for Colorado, here's why they're coming here. Our price per unit we just saw was about $128,000 price per unit in Des Moines. Colorado average price per unit, $242, 5.4 cap rates, and projected population growth, negative 2.73. If they're in California, why would you buy from California to Iowa? Well, their average price per unit is $317,000 price per unit at a 5.1 cap rate, and projected population growth is negative 0.3. So of course you don't want to be in California right now. New York, we love you guys as well. Your average price per unit, $335. 5.8 cap rates, a little higher cap rates. They're closer to ours actually, but they also have things called rent control, which we don't have that here in Iowa, thank God. But that's why you're seeing those higher cap rates in New York, because they have a lot more regulations. However, population growth still going down, and those high price per units. They're choosing Des Moines, they're choosing Iowa because of our values. They are so much lower than where they're coming from. And our cap rates are still very similar, and we have a lot of growth. In fact, this isn't even shown here, but CoStar just came out and announced that Des Moines was the fastest growing metropolitan area in the Midwest over the last 10 years. We're seeing about 1.6, 1.8% growth population-wise year over year. And so we're the fastest growing metro. People are coming here, they're seeing all the growth, all the people, and they're buying into the values. And so the takeaway here I'm coming out year over year is that Des Moines and Central Iowa continues to be very robust in pricing and sales, especially in, so then the tail wagging the dog thing, newer complexes that are larger. If you have 100 plus unit, 1980 vintage or newer, you are going to attract a ton of interest from out-of-state money and even international interest. Why do I say international interest here? This is rumors on the street here, so you're all going to hear this first. The Denner portfolio, which just came out for sale with CBRE, 1,610 units. The rumor is right now one buyer is going to buy that. The rumor is it's a Canadian group who's buying it for $200 million, $125,000 price per unit, and a 5% cap rate. If this happens, it'll be the first time we've seen international money come to Des Moines, Iowa to purchase. It'll also be the largest sale in the history of Iowa by number of units and by price. It'd be almost a $200 million transaction in one fell swoop, and it's one owner who sold off this entire thing. So again, it hasn't confirmed yet, it hasn't closed, but we may be seeing international money come to Des Moines, especially in, again, newer assets that are much bigger, a couple hundred units at a time. As I say all this here, back to my movie Hercules, the little old Disney movie there, be careful. This is a word of caution. All these sales are reflections of a market that happened 90, 180 days ago. So we're talking about all these things that happen right now and what we're seeing, but again, they're all just reflections of what has happened. Here's some things I'm seeing that are cautionary right now. It's giving me pause. Newer and larger assets are doing great. However, for anybody online here, we all know this. If you own property that's older, 1960s, 1970s, 1910s, 1920s, insurance is making it a complete nightmare for you to get insurance. In fact, they're probably trying to drop you. They're trying to get you to go somewhere else. I believe we're down to only 3 companies that are only insuring in Iowa right now. So they're making it absolutely miserable for all owners of older projects. Also, of the 27 new listings hit the market in Des Moines in 2025, if you've noticed, look at the details, most of these are actually older assets and they're smaller. We see the Denner portfolio and a couple of EP True as well, but most stuff getting listed is actually smaller, older product types. And these were affected by the run-up. What was happening in this pricing model of 2020 to 2022, 2023 is as these higher price units got sold, they were dragging the entire market up. And it made all these older assets still selling at high price per units, high price per square foot, and low cap rates. And someone was saying A, B, or C, I don't care. I'm willing to pay a similar price no matter what it is. I just want to buy something. And so that's why I think over the last 5 years, as I look back to all these numbers and these reflections here, I really think we're going to start seeing some differences in the marketplace. What we saw again was all A, B, and C get treated the same, exactly the same in pricing, everything. However, I think we're at a point at what I call an inflection point. I think we're going to revert back to the old ways, the old days, where small multifamily and small multifamily is considered less than 48 units, and large multifamily are starting to be treated differently, especially across different asset classes, A, B, and C. I think we're going to start seeing this get back to more and more of the fundamentals, the basics of not just buying a C class, hoping rents are going to go up, or trying to quote unquote value add, force value. We're going to start seeing C class get priced differently than A and B. And again, the newer the product type. And this goes back to the mentor's warning I was talking about earlier about sometimes the best deal you do is the one you never do or don't do. I really think a lot of these owners who bought in 2020, 2022 are starting to see that, especially the owners who bought the older C-class, smaller multifamily here. I think they're starting to have issues with insurance, with taxes, which we're all seeing as well. And then, of course, their debt's starting to come due at 6-7% interest rates right now, today's market. Also, these smaller deals where you're not able to get financed with Fannie Mae or Freddie Mac debt. So again, it's all local financing coming to fruition here as they get through things. And so I think we're going to start seeing, again, a huge shift in valuations between small multifamily and large multifamily. And specifically, the key is going to be the vintage too. If you're newer than 1980, doing great. Newer 1980, large properties, you're doing excellent. Older 1980, I'm seeing challenges, especially in some of the smaller stuff. And so here's my predictions. This is only my prediction going forward here, so don't sue me. This is not some attorney thing or anything here. But I think today, right now, we're seeing actually a decline. As I said about the report, talks about where we were at. I think today we're down. I think A class actually is going to be flat and neutral coming forward here. I want to talk about why I believe that. I think if you own B class, actually I think values are going to go up in B class assets right now. And by the way I define A class and B class, if it's newer than 2000 built vintage construction, that is a version of an A class unit, in my opinion. B class, 1980 to 2000. That's right. Anything older 1980 is going to fall into C class, 60s, 70s, 50s, 40s, etc. But I think A class is going to be neutral. I think B class, anything newer than 1980 is going to do well. And then I think C class is going down. I think C class has some issues coming in the marketplace right now. And again, that's partially because of all the listings we've seen hit the market, insurance, taxes, and also rental growth is slowing. We're going to get into rental growth a little bit later on too. And so why do I think this here? Well, over the past 5 years, A class is doing really well. It's been really just seeing a lot of boom and bust here, especially that happens. So what happened is these interest rates spurred a lot of construction all across the country. In fact, actually across the country, we've seen more multifamily get developed in the last 5 years than we've seen in the last like 15, 20 years. We've seen a ton of supply come on the marketplace. As a result, it's affecting vacancy right now, especially if you're in Waukee. By the way, if anybody's in Waukee right now, around the new high school, you've seen a ton of apartments hit the market. We're definitely seeing vacancy down there, over there, and downtown. And so this is why I believe A class is going to be just flat and neutral, because we have to absorb all this new supply we built online. Also, COVID has burned away all of the concessions here. Everyone's here, all that's gone. And it seems like more and more, a lot of these residents in the A class units aren't able to afford some of these newer rents or these higher rents. We're not able to have an apartment complex hit the market at $1,500 a month rent and get leased up in a matter of a few days. They're being more and more cost conscious, I should say, as they rent these new units, especially in the face of supply here. So what I'm going to do, though, I think, though, it should stay stable, because a lot of these A-class units are still built in great areas. Downtown Des Moines, Waukee, Urbandale, Grimes, Johnston, Ankeny as well. They're still really well located, and they're located in good suburbs that are growing. Again, back to Des Moines' population growth, we're growing. So I think the A-class will find its hold in the marketplace as Des Moines grows, and they're still going to be okay because they're well positioned, well located, basically. Location still matters a lot, and that's where all this A class is being built, is in the suburbs or downtown. Now B class, I think over the past 5 years, B class has been the one most untalked about. And the reason why BX has not been talked about is because everybody's gone either to A or to C. They've gone to A class because it's all new and shiny, or it's being developed, or they've seen these high rents, or they're going to C class searching for the value add. I think B class has remained almost untouched. And that's why I think B class is going to do well because of that. Also, because as insurance, as I talked about earlier, just to continue to destroy the C class marketplace, investors looking for newer assets that are more of a value today, that are cash flowing today. They don't necessarily want to have the whole rehab on a property. They want to just come in here and say, you know what, it's cash flowing a little bit. Maybe I can raise rent through operations, maybe through slight rehab, but I'm okay with that. And so I also think as A class tenants get squeezed, again, their cash flows down, they're continuing to look at B class assets that are a little bit still well located, maybe not as newer, and all the amenities, but again, well positioned for them to actually be able to pay their rent, as opposed to A class, highly amenitized, new location. And so again, I think B class actually is going to go up in values, and we're seeing that here. As again, we talk about this whole theme here. We saw Q1 last year, Q1 this year, that 124,000 price per unit, up from 74,000 price per unit. We're seeing that same story trend line as well. Again, newer vintage properties selling for higher and higher dollar amounts. I think C class is going to be the one we're going to see the biggest issues in right now. It was very, very hot when money was cheap because everybody wanted value add. We saw a ton of people come from out of state, Colorado, New York, California, et cetera, looking for value add, which is great. And they want to come in here and fix property up when money was cheap. And so a lot of these properties were getting priced very similar to B and A class assets here. However, their notes are coming due. We're seeing it all the way across the board. Banks are start trying to figure it all out, or their IO period's coming due. Some of these deals were only making sense if they had IO as well. And so these performers also are becoming more challenging. As rents have kind of, the rental growth has slowed down, we're gonna go to that in a second here. As rent growth has slowed down, these performers are becoming more and more basically crap. I'm just gonna say what it is. They're not working. And so more and more these C-class assets are being challenged here, which goes back to my mentor's earlier comment about sometimes the best deal you do is the one you don't do. And so I think C class is going to see the biggest value drop or the biggest issue coming forward, at least over the next 3 months to 12 months. This is all short term. I don't know the long term, but short term is what I'm seeing. So we talked a lot about values. Now let's talk a little bit about cash flow here, what we're seeing in rent growth, expenses, et cetera here. So let's get into what we're seeing that on a daily basis here. As always, if you don't know, we're going to talk about rent growth. Expense escalation, one thing many people forget about is that yes, rent goes up, but so do expenses, which is what we're seeing a lot of. Rental rates, obviously, and occupancy rates here. So what are rents doing? This is the 10-year trend line from CoStar pulled out right now. You can see we're forecast to see that rent growth year over year go up. And it's saying right now, looking like next year, this year or so, about 4 to 5% rental growth. That's what they're saying to us. But you can also see that it's definitely down from where it was. You can see if you look at 2024 here, look how much it's been down rental growth from where it was at in 2022. That's because of all the supply we've had come on the line in the last year and still coming online as well. If we look at it, the 5-year growth annualized is 2.58%. That's annualized rental growth here. What I want to point out for anybody that's been on my past webinars, this is down significantly. It was 4.2% annualized over the last 5 years. We're down to 2.58%. The reason why, again, supply. A lot of units coming on market. They're vacant. They're offering concessions, especially in the Waukee markets, et cetera, Ankeny. So we've really seen rental growth over the last 5 years take a hit over the last 3 to 6 months. If you are looking to buy or sell and you want to use a 3 to 7 year underwriting model, if you're trying to sell it to your banker or your investor, whoever it is, I do recommend you use a 2.5% rent growth in your models if you want to use that. 5-year expenses, this is based on inflation and based on what I can find, 3.8% expense growth. So we're going to talk about this here in a second, but if you're looking to sell, use 3.7%, 3.8% in the last years as well. We're going to look at what that means in a second more. For any legacy owners, a legacy owner is someone who's owned for the last 10 plus years. Usually 10, 20 years is what I call a legacy ownership group, someone who's owned a long time. What we've seen over the last 20 years, historical growth for all of central Iowa, about 1.57%. That's historically speaking over the last 10 plus 20 years. So if you're looking to hold for properties long term, if you're just saying, hey, if I want to buy this, I want to retire on this, we can utilize 1.57% rent growth in our statistics and our underwriting models just to see what we're doing there. Historically speaking, over the last 20 years, inflation's been about 2.2% since about 2000 or so. And so if you're looking to actually own long term, again, we want to underwrite expenses going up about 2.2% annually over the next 20 years, 20 or 30 years here. So what does this all mean when we put them all together, compare them? New ownership groups have actually lost rent in the last 5 years. This is the first time we've seen this. If you do the math on it, 2.5% or so of rent growth, and then we see 3.8% expenses, inflation. For the first time, we're seeing in the last 5 years, expenses have actually gone faster than all of our rent growth. And so new ownership groups have actually decreased NOI organically by 1.3%. Now, if you actually force it out, another story. But if you look at sheer organically, they've actually lost money. If we look at legacy multifamily ownership groups over the long term, you've actually lost rent organically by 0.6%. Compared to inflation at 2.2% and your rent growth about 1.5, give or take, you've actually lost value through that, or your cash flow at least through that here. Now, that's a little bit misleading here still, because even though we've seen declines in rental growth for new ownership groups, we've seen sales and equity continue to remain strong and go up and increase. As we talk about this whole presentation, values are up almost 70% in some spots. So even though we've seen rental growth slow down, values are still high. And as I talk about, again, I keep in this theme more and more as well, but that new supply is in the marketplace and checkbooks are getting hit, but there's still some fire there, there's still embers burning here, there's still some values being seen here, burning off on this whole thing here. So I think we're still seeing, again, that strong pricing model, and I still think we're going to see some rent growth for the property that especially is being managed very, very well, operationally very well, maybe that B class up as well. I think it's going to see some value in that go up. And we're seeing also a lot of owners, legacy owners, start to raise their rents as well. Speaking of legacy owners, you've lost rental growth over the last 20 years, but again, we're going to keep re-hitting this here. Your sale prices, your equity has skyrocketed. I mean, if you've owned property for 20 years now, hopefully you're retiring the debt. If you haven't yet, you can be. But you're going to have a ton of value in your properties right now, especially, again, if it's anything newer than 1980, bigger properties, it's definitely a lot of value there. Pulled from CoStar. This is only CoStar information, not mine, so don't quote me this one. Studios should rent for $869 right now in Des Moines, Central Iowa. One bed $1,003, two beds $1,168, and a three bed $1,382. As you can see here, this is also across all metrics though, A, B, and C class, all marketplaces here. So a little bit misleading here, but that should be numbers for you guys all to look into as we're underwriting stuff here. So our current numbers right now for vacancy is 7.8%. As of right now, what they're telling us here, and it looks like what Des Moines is telling us for CoStar, we're going to see that occupancy rate start to go up, vacancy burn off, and we'll get back down to about a 5 or 6% vacancy rate coming in the next 2 or 3 years. And again, average is about 3 to 7 or so. So definitely a little elevated compared to previous histories. But again, we're still seeing that burn off. So what does this mean? My opinion's in only. What the market's telling us about values is that newer and larger deals are in demand. Value add continues to be a theme, especially from national and international investors coming here. But part of the value add is going to be more in operations or in the growth of the Des Moines marketplace, I think, especially in newer locations like Ankeny, like Waukee, maybe even Altoona, Grimes, Norwalk, etc. Older properties, incredibly hard to sell right now. What I'm hearing across the board from many different buyers is that they're putting these properties under contract. However, they're getting tough times getting these things to actually appraise or a lender to give them the money on the project. Appraisers and lenders right now are making things incredibly challenging to close. So what you might be seeing on the marketplace is say, hey, look at all these properties getting listed and look at the properties, what the prices are going, for getting listed at. True, but are they selling? There's a difference between properties getting listed and properties selling. And again, from what I can tell, newer projects, bigger projects, they are still selling. Older, smaller assets, they're getting listed, but they're not closing. And that's what I'm hearing about across the board, again, from appraisers, from bankers. We're really seeing challenges in those older projects actually getting to the finish line. For cash flow, I think what we're seeing is A-class rental growth has slowed. So I think A-class new stuff built after 2000, 2015. We're seeing a lot of supply there, definitely challenging cash flow. B-class, well positioned. I think B-class is going to see the most rental increases and good cash flows. Also, because you can still get insurance, quite honestly. C-class, I think C-class is in for awakening. I think rent growth is going to continue to maybe stay flat there or even go down. Especially as we just see a lot of these rents. I'm hearing about C-class units where their rents are almost similar to B and A class in some cases. And as that happens, you're going to start seeing these tenants say, hey, why am I paying $865 for a 1-bedroom apartment in an older product when I can go pay $900 for a B class unit or $915 or something of that nature. So that's what I think is going to happen for the cash flow here. So where we're seeing a lot of locals win, I would go as well. Locals are still winning. We're still seeing locals do a lot of smaller deals, 8 to 48 units here. However, we did just see also the local institution buy Polo Club for 38 million here. So we are still seeing some locals even still double down and bet on our marketplace. If you are local and you're looking to do deals and buy, focus on affordable deals and focus on knowing the intricacies of the market. Let the big guys be the big guys and let you do what you do well. Syndication groups are still winning as well. They're still making offers. We're seeing them win a lot in that medium-sized, bigger deal. 4,800 units. Definitely seeing focus on value add as well. And they are definitely focused on the B-class markets right now. Heavy B-class market for syndication. Most syndicators have almost pulled out of the C-class market from what I'm hearing about in the marketplace because, again, they can't get insured. And many times the syndication groups are coming from out of state as well. And it's coming out of state, they can't get financing, they can't get insurance, they're focusing on B-class assets. Again, why I'm seeing value there. Institutions, I talked about they're winning on the big stuff. Newer 2000s, newer 1980s, large complexes, Polo Clubs, great example of it here. If the Denver portfolio sells, that'll be another great example of institution coming to our market and really betting on the essentially making money on their money, the capital markets. 3 things to watch for as we kind of wrap this up here and move into the end of this all or even the questions. First things first is what's going to happen in these newer listings. I gave you my predictions of what I think is going to happen. Now, with that being said, they still could sell. Again, I said it earlier, I don't know the future. I can make predictions based on what I'm seeing in the marketplace and the stats and historical data, but I don't know what's going to happen. If we start to see these new listings that are all older sell, and especially if they're older assets sell, we may still be in a market that's going up. I don't know the answer to that. I think it's going to go down from what I'm hearing about and seeing, but I could be wrong. So definitely watch closings on smaller multifamily that's older and see what they're selling for compared to what they're listed for. Definitely keep an eye right now on tariffs. I know we're all kind of making that's kind of a joke here, but like tariffs right now, based upon basic math, is they create inflation. Inflation is good for us in real estate. Makes prices go up. And so unless we all hate inflation, it also makes our properties more valuable. And so we're definitely watching tariffs just because of what that'll do for inflation. Not so much I care it's not going to really affect Des Moines, Iowa as much as you might think, but I think the inflation is something to look for. The third one I want to look for is the spring market. Coming into the spring market, we're seeing a lot of vacancy, a lot of occupancy issues as well. I'm really curious to see what the spring market will do for occupancy rates. I don't think we're going to see rental growth go up that much. We've already seen that happen the last couple of years, not this year. But I want to see what it does for occupancy rates. That's what I'm watching pretty heavily as well. So the conclusion is here, as I kind of wrap this up here and come to the end of our hour together here, prices and values remain high, and they're still going up. I want to keep reiterating that here. We are still seeing very high prices again, recapitalizing here about $124,000 price per unit. We're about $130 price per square foot and about a 5.4% cap rate on 69.7 million or so of sales volume, 1980 vintage. But I also want to point these prices are also a reflection of a market that is 60, 90, 180 days old. So does that mean we're going to go up still or not? I don't know, but that's what we're seeing. Like I said, my opinion, we're seeing a divergence in the marketplace. I think we're going to have, any members of this comment, the K-shaped recession, which we had after COVID. K-shaped meant some went up, some went down. I think we're going to see B-class go up. I think we're going to see C-class go down and A-class remain neutral. So we're almost going to have like an E-shaped recession, if you want to call that, or E-shaped something. That's what I think is going to happen in the marketplace right now. For values, I think, or rent, I think A-class, totally flat. I think B class, we're seeing see the most growth right now, especially as tenants' pocketbooks get hit. And we're seeing C class rental rates are challenged the most as some of these value add investors try to push their rents up in face of higher taxes, higher insurance, and hit their numbers, their metrics as well here. And I think those C class rents are getting close to that B class, and the tenants are making a choice to go more and more to the B class units. So with that being said here, we are actually right on an hour here, getting wrapped up. What are questions everybody has right now in the chats as you're coming in this all? What are questions you're seeing on values, the marketplace? What can I give some insight on? And not all at once. Any questions at all? Thank you, Chloe, from the chat. No questions? Makes it quick and easy. Any dialogue? Anybody want to have conversation? Anything else? Because otherwise, after that, all we really have is just wrap up. Just find kind of make sure you need me. Where are you seeing B class values at, Kathy? To answer your question, I think it's going to tie back to what I said earlier. I'm seeing the B class right about 124,000 price per unit right now. Depends a little bit on your rents and where those are at here, but I'm going to say B class is somewhere in that 100,000 per door, maybe 110. Depends a little bit on your unit size and a little bit on your rents. But we are seeing that 100,000 per door be pretty common across most of the B class stuff, especially if you're in a well-placed market where people think they can get that value that was rents up to $1,200, $1,300 a month rent. So if you think you can get $1,200 a month rent right now out of your units, or if you want to even test that, I would say pretty commonly you're going to see prices about 100,000. Weston, to answer your question, 3 insurance companies that I'm seeing still active in the marketplace. Right now, we're seeing Shelter Insurance still be active. We're seeing Farm Bureau still be active. And then we're seeing Auto Homeowners still be active right in the marketplace as well. Now, I did also hear a rumor that Auto Homeowners actually is selling their entire book of business. So they may be getting out of the market here as well. Where I'm not for sure about that, but we'll see. Ryan says, do you foresee several C-class foreclosures in the next 12 to 18 months? Honest answer to that actually is no. And what's happening, I'm seeing across the board is, maybe remembers this, some of us old timers do. In 2008, 9, and 10, as a lot of these banks were going through the foreclosures of all the houses, they were doing pretend and extend for a lot of commercial properties. And what they meant was they wanted to pretend it wasn't real, pretend we weren't in a recession, and extend people credit. And so what we're seeing happen right now, almost across the board, is the same thing. Many banks and credit unions are saying, hey, look, it worked in 2008, 2009. Let's pretend and extend a lot of these borrowers. And so a lot of these borrowers with their debt coming due in 2025, you're already having the banks and credit unions come out and do carve outs and say, you know what, we know you're not doing very well right now, but we think it's going to get better. Let's not call your note due. Let's not put you in foreclosure. Let's extend your note out to 2026. And then we'll see what happens then. And so a lot of them are working as well, or they're saying, hey, look, you can't make principal payments. It's okay. Just pay your interest to us. Just keep paying your interest. Okay, your interest is going from 3% to 6%. Just pay us the interest. We'll focus on getting this thing sold later on. And it's also because a lot of these banks, they don't want to manage these properties. Now, what you're starting to see from what I'm hearing about from rumors across the board, this is not just Des Moines, this actually ties into, I'm hearing about in San Antonio, I'm hearing about it in Florida, I'm hearing about in Austin, Dallas, Houston especially, some of these big markets where we see a lot of appreciation. We're starting to have like popcorn pop off, where banks are saying, yeah, we'll extend most people, but there are a few smaller banks who are saying, I can't extend you. This has to come due. We're calling note due here. So we're starting to see some one-offs hit where people are saying, hey, look, I can't extend this anymore. So there's going to be a few out there, but not as much as we might think. Because again, most banks are just extending out. They're just trying to push it off longer and longer because they don't want to come to realization that they might have to actually call some of this debt due. Good question though, and that's something that I think is being talked about. Maybe not as quite as often as it should be, but we're definitely seeing that happen a lot more. And again, banks aren't announcing; they're not making it public that hey, we're extending these things, but a lot of them are. Other questions? Feel free to unmute yourself or throw in the chat for anybody that wants to ask any more questions. Thanks, Weston. Did I see one more question there? Nope, just Jason here. So we're gonna hit stop share here. Just come back to regular old screen here. And with that being said, guys, this is over now. So if you guys want to get back to your days, whatever you want to do, feel free to get back. If anyone wants us to stay on and chat for a while, I'll just leave it open for anybody to chat. And we're all, I think most of us here are all owners. Looks like from what I can tell. So if anyone wants to sit here and chat and see what's going on in the market, happy to sit here and just have open dialogue here.